Let's talk about the types of supply and demand zones. Basically we have two types. Swings, which are composed of valleys and peaks, valleys for demand and peaks for supply, and continuation patterns, which we call CP, which is a pause in market. So let's take a look at, first of all, at these swings, valleys and peaks. They are normally a reaction to CPs, to a CP or another swing, normally to a CP, and they are best at the extreme of the curve, the origin of the whole move up or down. So let's identify the valleys and peaks. They are normally at the trendline confluences and higher time frame areas of supply and demand. Let me take a look at this. Let's continue with the Aussie example on the daily. So we have two types of levels. We've got valleys, okay, and peaks for the swings, and then we've got the continuation patterns, which are levels that are uh, rally-based drops, drop-based rally, like this one, rally-based drop, rally-based drop, rally-based drop. So these ones are CPs, and this is a valley, and this is a peak. These are the two kind of levels that we have. Okay, this is a rally-based drop, this is a peak, a swing, this is a peak, this is a drop-based rally, this is a valley, this is let's say here, drop-based drop, this is a CP, pause on the market pauses there and then drops. This is a rally-based drop, this is a peak, another swing, this is a drop-based drop, this is a CP, rally-based drop, peak, rally-based drop, peak, drop-based drop, CP, potential CP, pre-CP. We'll see that. So these are all the kind of levels that we have. As you can see, the markets, when you look at the charts, you will only see three type of levels, two type of main levels, and one of them is composed of two, and valleys and peaks, and then the CPs. Each of them have their uses, and they are related to the curve. So on the swing side of the type of levels, we have the valleys and peaks. They are normally a reaction to a CP. Why do I say that? They are normally a reaction to other levels. Let's take a look. We've got this valley here, over there. Okay, let me draw the level on with the rectangle relay indicator. This is a long wick, as you can see. This is a peak, a valley, and then this is a peak. So we could say that the whole move started from down there, and the top of the move started to drop from down there. So this is very high in the curve on this chart on the daily, and this is low in the curve. We look at the streams. So when you look at these long wicks over there as well, it's fake out over there, these zones will normally, these long wicks and these zones at the extreme, the valleys and the peaks, will normally be reaction to previous levels here on the left, mostly CPs, other times to valleys and peaks. So this is on the daily. On the daily we won't be able to see it very well, okay? But you can see here, yes, there is a reaction to this area over there, and then on the daily we've got a reaction to this area over there as well. So these, let me draw a horizontal line over here, and let's see where it reacted to this area over there, as you can see. And then this one over there, it is a reaction to this sort of area. When we go to the one higher time frame area, we will see that we have also another area here, weekly area of demand, weekly area of supply. Price moves from one area of demand to the opposing area of demand on the time frame where we are looking at. In this case, is the weekly. When we looked at the daily, we couldn't see it really well, but as you can see here, when we've got a valley, it normally is a reaction to a CP. When we've got a peak, it normally is a reaction to another CP. In this case, it is not, but normally it is. Okay, else to another area of demand, a valley or a peak or a higher time frame area higher than the time frame that we are looking at. Okay, it's like here, price drops, creates a valley. Okay, where does it react to? React to this CP. Normally, valleys are reaction to previous CPs. Okay, this is another valley. Where did it react to? That CP over there. This valley reacted to this CP over here. Okay, so normally they are reactions to CPs, but many times also they are reactions to valleys and peaks. So you have to take that into account. When you see a valley, you try to look at the origin of that. Why did price reacted from down there or up there? Because it will normally be a reaction to a previous level of demand or supply. Okay? Just don't believe what I say. Just look at the charts. Okay? And then you will see how that works. This is a weekly area. So this defines these 2 points. So the valleys and the peaks, since they are a strong reaction from CPs, they normally create the imbalances that will probably cause a reversal in the area like down there. So they are best used at the extreme. Okay, it's a valley and a peak, and then the curve, the 50% right in the middle. Okay, the valleys and the peaks are normally used for the curve, whereas the CPs are not. Okay, they are normally used only if we are in a trending market. We will take a look at those rules when we work on the curve. So valleys are best at the extreme, at the origin of the move, and they are normally reaction to a previous CP or another swing. Okay, this is how the market works according to the dynamics of the markets. Okay, so we've got another type of level, and that is the continuation pattern. Okay, they are best at the beginning of a move. They are low odds if prices overextended or too high in the curve. The higher in the curve, the lower the probability of a CP. And low odds if previous trend line is broken unless it is located at a high time frame flip zone or a high time frame area. So here, let's take a look over here. A CP is a continuation of a move up or down. So we take a look here. We've got rally base, rally base, rally base, rally. Okay, we've got several pauses in the market, which are great when we are trending up and we are breaking and removing areas of supply over here. But once the trend line is broken, as defined by the rules, the CPs on the way up are no longer high odds. Okay, so these Marubosu, they're out. This is out, out. All of them are out. So price tends to retrace all the way back to the origin of the move. But if we don't have a good base, then we don't take the trade. Okay, this is not a good base. We will take a look at that at the scoring of a level. So once the trend line is broken, then we have to lean on a valley or on a higher time frame area of demand to trade, or on a valley normally. So here, as you can see, we've got CPs at the origin of the strong, explosive move. CPs are really, really nice, like this. Okay, there, here, rally, base, rally. Here, there's a drop, CP, CP, CP. So the higher we are in the curve and the closer we are to a higher time frame area of supply, higher than the time frame where we are detecting the CPs, the lower the probability of that CP is. So when price hits at a higher time frame area of supply, this CP on the daily is lower odds because we have hit one time frame higher area of supply, that is on the weekly. We are now on the daily. Okay, the same applies when we are trending down on the daily. We are trending down here, then CPs as we progress on the drop, this CP is high probability. Okay, this CP is high probability, and this CP is lower probability now. Why? Because we have hit a one time frame higher area of demand on the weekly. Okay, same applies here. We hit a weekly area of supply, and then we have this daily CP not holding very well. So remember, the CP, the lower you locate it in the curve at the beginning of the move, the higher the probability. The lower the probability will be, the closer to a higher time frame area of supply, of opposing area of a higher time frame area of the closer to a higher time frame area of opposing zone, if we are taking a look at CPs of demand, the closer to a one higher time frame area of supply, the lower the odds. The more CPs we have in a row, the lower the odds will be the last CPs that happen in that row. Okay? So try to look at CPs that are low in the curve at the beginning of the whole move after the trend line break and hitting the higher time frame area of demand, because those are the highest odds. Okay? And this is it for the CPs and the type of levels. Okay, summarizing, we have two types of levels: swings, which are composed of valleys and peaks, and continuation patterns that are CPs opposed in the market. Okay, thanks a lot.